Welcome to this thematic discussion brought to you by Livewire Markets. My name's James Marley and today we are talking income and specifically income from dividends and if we can find it, some fully franked ones. I'm joined by two gentlemen that know all about income and dividends. I've got Dr. Peter Gardner from Plato Investment Management and Michael O'Neill from Investors Mutual.
Dr. Michael O'Neill.
Oh, you're a doctor as well. There we go. Two doctors and we're in good hands. Dividends have been an important source of income over the past decade. More than 80% of the return from the market has come from dividends. But in 2020, there were a few wobbles. We had deferments, we had industries under pressure, and the outlook moving forward is for a slightly more subdued return from dividends. So we're going to need the two doctors to help us find out and sniff out a few specials. Michael, we'll start with you. One word to describe the outlook for income in 2021. What is it?
Compelling.
Okay. Same question for you, Pete. One word.
Improving.
Okay. So we've got two bulls. Pete, we'll stay with you. Let's talk about that improving outlook. Give us a few stats. Convince us why the outlook is improving.
Yeah, so if we break the market down into a few different areas, there are some stocks that had big cuts in dividends in 2020 and most of them are still in the doldrums in 2021. Unfortunately, those kind of COVID-related trends have continued, such as the travel stocks. We've had other stocks that have done really well out of COVID, such as the retailers and the iron ore miners, and the tailwinds are still behind them. And so we're expecting strong dividends from them in 2021 as well, and potentially even increasing. But the real swing factor for us, and the reason I said improving, was because of the banks. We expect the banks, the payout ratios were maintained at 50% given the APRA rules, but now that's been taken off, we expect the payout ratios to go back up to 70%. And so we expect improvement from there. In the longer term, potentially as things return to normal, you'll see some of those stocks in the doldrums coming back, but not for the short term.
Okay. Compelling. It's a bit more bullish than improving. Why is the dividend outlook so compelling?
Well, if I could just take one component of the market Peter's not described, which is the non-bank industrial sector, the defensive part of the market that's been left behind. I think, as well as the sectors Peter's point to, this is the really exciting hunting ground for yield investors. You don't have to chase some of the cyclical sectors or the sectors that have benefited from COVID to get an improving yield. Fair to say a lot of industrial companies have been conservative in the past year, holding back capital, in some cases raising capital, and their yields look quite compelling when you compare them to fixed interest, cash and property. So if you can take these as the building block, perhaps get some diversification of your income through shares, whether it's through franking and also simple option strategies, defensive equities do prove to be quite a compelling proposition for investors.
Okay, we heard about it from Peter. It's hard not to have a conversation about dividends without talking about the banks. I think I've seen some research from Plato at some stage that nearly 50% at one stage, nearly 50% of the income from the market was coming from the banks. Of course, that got put on hold last year. Is that an obvious source in 2021? What do you expect for the banks?
Well, look, we do expect improving yields from the banks. And I think it's fair to say yields are improving faster than we would have expected, both because of strong stimulus measures, unprecedented stimulus package, and also deferral measures have largely worked. Deferral books of the banks are shrinking rapidly. We've seen bad debts in the second half reduce. We've seen the outlook for house prices be buoyed by these stimulus measures, and dividend restrictions are being taken off. So now the yields do look tempting. However, we do caution investors over concentrating in bank shares. Their returns are structurally challenged, both by the record low cash rates we have, but also the fact that the majors are losing share in mortgages. So our focus is on generating income with a better risk return outcome from the non-bank industrial sector.
So some of those pressures that were there pre-COVID remain for the banks?
Yes.
All right. But you were pretty upbeat. You thought it was a bit of an opportunity in the banks. Could I get you to be a bit more specific? Is there going to be catch up on the dividends that were deferred? What sort of yields are you expecting to get out of there? Have you got one that you prefer over the other?
Yeah, so we're not expecting catch up initially. We definitely agree with Michael that in terms of the banks, they're still kind of under a fair bit of pressure at the moment. But after saying that, their capital ratios are extremely high and well above the unquestionably strong. So we don't think it'll initially happen. If you looked at APRA's statement, they still said banks need to be conservative. But potentially after JobKeeper ends, if things don't go too bad after that, if we don't see a lot of bad debts or businesses going broke at that time, then we expect the banks to increase their payout ratios, and potentially you could even see a few banks do some capital returns in the form of off-market buybacks. That's definitely the potential. Some of them, like CBA, were announcing they were going to do one before COVID, and that obviously got put on ice, and so potentially as things stabilise, then they could do that again.
Okay. I said, did you have a preference? Are they kind of all the same? Are you buying one, you're buying four? Is there a preference?
There is a slight preference for CBA at the moment. It's a bit more defensive and it's got a bit more kind of capital that it can return to investors. But they are fairly similar in the current market.
Yeah. So if we wind back the clock to 2020, March rolls through, everyone kind of takes a deep breath. We don't know how it's going to play out. But there were definitely some surprise winners. The resource companies had a stellar year. Commodity prices at record highs. You've got Fortescue Metals spewing out cash. Some of the retailers did really, really well. I guess if you talk about some of those slightly surprising alternative or non-traditional sources of income, the question is it sustainable? Do the tailwinds that have sort of fanned their dividend payouts, do they continue in the year ahead?
We think they continue in the year ahead. So the tailwinds are still there. Retail sales are up 20% for most of those stocks or more from what they were this time last year. And so it's very strong right now for the retailers. The iron ore price is obviously up around $150, I think, US, which is very strong at the moment. And so we think the tailwinds are there. But obviously in the medium to long term, we're not expecting retail sales to stay up where they are. As people start spending again on travel and on services, then we expect retail sales to come back down. We expect the iron ore price to gradually come back down as well. But as with most things in life, they take longer than you expect. And so we think that's the case with cycles as well. And so we think this cycle still has a fair way to play out, and we're expecting high dividends from those companies for sure.
Okay, same question to you, Michael. A few surprising winners from 2020. You've called out those defensive industrials. What else caught your eye as being, a surprising source of income that people could turn their eye to?
Our focus is very much on those companies with sustainable dividends based on recurring cash flows who don't overpay against their long-term earnings prospects. So opportunities and winners for us in 2020 were, for two examples I'll give you, Metcash and also Nine Entertainment. So in Metcash's case, strong performance across all three divisions, supermarkets, liquor and hardware. It's fair to say I don't think the local shop is going away anytime soon. It's not a COVID phenomenon. Their earnings are sustainable. They're reinvesting back into the stores. And in the case of Nine, that presented an opportunity because the stock sold off strongly against what was a fall in ad budgets at the start of COVID for traditional media, such as free-to-air. But in the meantime, COVID has accelerated that trend towards digital, whether it's Nine's Stan or Nine Now, and also their online newspapers. So digital is becoming a growing proportion of their recurring revenues. And also, if you add in their stake in Domain, it's the vast majority of their valuation. So that's another sustainable opportunity that we benefited from.
Yep, so changing quality in the business there.
Yes.
Sustainability is a word we've touched on a few times there, and it's what everyone wants in dividends. Was there a company you could call out, or a particular part of the market that just really surprised you or impressed you with how sustainable and resilient it was last year?
If you're looking for impressively resilient dividends, AusNet is a great start, pays over 5.5% yield. That's underpinned by their essential energy infrastructure. Their returns are locked in 5-year intervals with some smoothing with the energy regulator. They do get some growth in that distribution because over time, we're seeing billions of dollars invested in renewables which need to be connected into the grid. I guess another area of very resilient dividends is the supermarkets. So, we've gone from a period where we've had heightened competition, a lot of price deflation, and now we're coming into food inflation, improving margins, and predictably growing earnings. Again, quite a resilient dividend stream. Okay.
Peter, same question for you. I mean, the Plato style is a bit more of a harvesting. You're really looking to cherry pick some of those dividends, if I'm right. But is there something that stood out as a company or a sector that stood out as being impressively resilient last year?
For us, it was actually the iron ore miners, which would not be a normally resilient area. People think of them as cyclical stocks that should suffer during a downturn, but we've seen it in the last two downturns, both in the GFC and in the global pandemic, where what has happened the last 2 times is that China, the way that they get out of these global pandemics is that global downturns, is that they increase their spending on infrastructure. Now, infrastructure requires steel, and that requires Australian iron ore at the moment. And so you actually saw the iron ore price during the GFC stay fairly resilient, or bounce back quite quickly, and the same during this pandemic. It actually rose during this time. And so we think they're surprisingly resilient dividends for cyclical companies, and we think the market's kind of a bit underappreciated that.
Okay, well, we've been talking like the bulls about all the upside in dividends. Let's go the other tact. What are some of the potholes? Because there's some big looking yields out there. There's double-digit yields on a few stocks. Maybe help our readers understand, some areas where you think it's maybe not so sustainable and they could be heading towards one of those fabled dividend traps.
Yeah, well, the electricity market at the moment is very under pressure for us. If you look at wholesale electricity margins, they've come down very significantly during the pandemic and afterwards. As people install more and more solar panels on their roof, that's putting more and more pressure on the market, and that's put incredible pressure under AGL and to a lesser extent Origin Energy. And so AGL is a big dividend trap for us. We actually think they've got enough cash flow in the business. Their balance sheet's quite strong, so it's not that's going to drive a dividend cut. But we think as their earnings start dropping, the management will have no choice but to cut their dividends. So that's the one we're kind of highlighting.
All right, one pothole there. Michael, same question to you. Something out there where the yield doesn't look sustainable and you're a bit concerned about it.
Well, I have to agree with Peter on AGL. For me, front of mind is Dexus. Dexus is paying over a 5.5% yield, which is attractive, but the trick is they're paying out 100% of earnings if you include maintenance capex and also lease incentives. This is at a time when CBD rents are at record highs. If you walk around Sydney, you'll see plenty of construction sites. A lot of supply will come in the next 2 years. And big corporates like Telstra and ANZ have said they're going to move the majority of their workforce to flexible arrangements, maybe 2 to 3 days in the office in the week. Now, on our numbers, a 1% change in vacancy rates in office can translate to a 6% fall in net effective rents. So the problem is, and where the trap might lie, is that the dividends are quite leveraged to any increase in office vacancies.
Yeah. Well, there you have it. According to our 2 doctors, if you got a little bit of a cold on dividends in 2020, things should be looking a bit better. You'll be feeling good soon in 2021.